Hello, it's Sunday, March 7th. We need to get ready for the trading week of March 8th. We need to review markets closed last week. We need to crank it up a notch, take it up a level. It's time to tackle the trade. All right, let's start out with last week's jobs numbers. They came in way better than expected. We had talked about that briefing forecast. We had talked about the expectations being 10% unemployment, and the number came in at 9.7%. That's quite a pleasant surprise. Now, I wouldn't be surprised if those numbers were corrected down the road, but for now, hey, 9.7% unemployment did come in better than expected, and the market showed that it liked that. So let's go ahead and minimize that. Look at the futures, and Friday's move was very strong, really strong move up. We had that move on pretty typical volume, typical day, and strong move up. Now, we talked about it breaking the resistance zone, and now it's moving up into that major resistance zone. And we had talked about it going minor range up, and we had shown that it had moved up minor range, and now we're expecting it to go a bigger range up. So we now have this larger swing range. That's a typical market move. And if we get that move, we are going to expect that market to run into that resistance zone over the next couple of days. So we're still bullish. All signs are pointing to bullishness. And what we need to see is the market heading up into that resistance zone. We're going to watch for it to slow down, but some continued upward movement for Monday and Tuesday. On the calendar for this week, you need to be aware of what's on the docket for this week. We'll go back to that Yahoo calendar and we'll come into this week. There's no major reports this week. It's kind of a light week for the number of things coming out. The big thing coming up on the docket is the retail sales, and that comes out on March 12th, 8:30 a.m. It is an important thing. It particularly will affect retail stocks. And on a scale from A to F on importance, this is an A-, so you need to pay attention to it if you are trading retail stocks. I want to show you guys a cool trading idea. And I'm going to dedicate this trading idea to the lovely Karen, the trading grandma. She can trade up a storm and knit you a sweater. And the reason I'm dedicating it to Karen is because we are looking at the DIG, one of her favorite securities for trading. It's the Proshares Ultra Oil and Gas. And it's an exchange-traded fund that tracks oil and gas, and it has a really nice pattern, a breakout pattern, and it's taking out that resistance zone as we speak. We can see it's actually closed out here above the support and resistance zone. That's a very strong bullish signal. This security has a $1.04 average true range. That means on an average day it moves about $1.04 between the high and the low. That is over 3% of the price of this security. It's $34.68, and that's over 3% daily movement, so that is awesome. Now, this being an exchange-traded fund, one of the other things we like about it is I'm going to go ahead and open up an options chain on the DIG, and I want to show you that this thing has option strike prices every $1. So you can see 30, 31, 32, 33, 34, 35, so on and so forth. There's a strike price every $1, and that makes for good trading. Okay, another awesome thing about the DIG, I'm using Mock Trader. It's a product developed by a guy named Tom Josephs, and it is an awesome platform, beautiful charting, and it has this killer feature at the professional level, which is called paydays and pay range, and it does some statistics for us. It does some number crunching, and it figures out that the DIG has an average paydays, which is the number of days between support and resistance pivots. The average number of days between support and resistance is 4.6. So you round that out, it's 5 days on average. And the average number of dollars, the pay range, is 4.48. So again, 4.4, 4.5, almost $5. So we're averaging about $5 over 5 days. I'm overstating the case, but that's the idea. I know how much this thing moves. Now, that being said, we can come back in and look at the chart And look, you can see the swing ranges. Let's look at some of those typical swing ranges, and here we go. It's up 1, 2, 3, 4, 5, 6. This one went 7 days from pivot to pivot, and we can see that that is a nice 5-point move. So we see it here, boom. You see it back here, boom. We have just established that this can run that 5 points, and it can do it in about 5 days. Now, from that little pivot it just formed, you'll notice this right here. And that what I'm going to do is I'm going to grab this line and drag it down and put it at that little pivot we're talking about. And it's up 1, 2 days. So if it's up 2 and it averages 5, that means there's at least 3 days left in a swing, if not more. And I'm going to grab another line here, and I'm going to go set that out $5. And that would put us at a target of 38. And you'll notice that that swing range, that'll get you there. So I am going to say we are looking at an upside range of 38. Now, here's where the cool trading strategy comes in. I am going to grab a risk graph on this, and I'm going to punch in DIG, and I'm going to show you a slingshot trade, or it's what we call a gamma scalp. It's a pretty fancy trade, and you need to know how to get in and how to get out, and there's some rules to it, but I want you to understand the concept. So what I'm going to do is I'm going to start out buying 100 shares of the stock at the current market price of $34.68. And what that'll give me is I have reward is unlimited on the stock, so I have unlimited reward. And I also have risk down to 0, so I could lose the entire amount of money I invest if I'm not careful. Not likely to occur, but of course there's always something that could happen. Now, at $3,468, that's 100 shares times $34.68. So it would require $3,468 of my capital to get into that, and the margin requirement on that would be about 1/3 of that. So that being said, it's going to tie up some of my money. But I'm going to take it one step further, and I'm going to buy 2 out of the money options for the month of June. I'm going to go out to June, and I'm going to buy $38 calls because that is that swing range up. And those currently cost $1.63 a piece. Now, I've already looked at this, and the delta, which is the sensitivity of the option premium to the movement in the stock price, is 36. And I need you to understand these numbers here. So I'm going to grab my calculator here, and we have a delta of 0.36. Now I'm buying 2 of these, 2 contracts, so I'm going to multiply that times 2. And then each contract is worth 100 shares of stock. So we have a delta of 0.72, and I'm going to multiply that by the 100 shares, and that gives us 72. So if it moves $1, I will make $72. Does that make sense? If the stock moves $1, which the average true range is 104, I will make $72. Now, I also have 100 shares of stock, so plus 100 shares of stock. And what I have is 172. Now, I'm going to multiply that by the average true range, which again was $1.04, times 1.04. Now, if I get an average daily movement out of that, I'm going to make approximately $178.88. Now, that's minus commissions and slippage, but this is the idea. Now, here's where the magic happens. I'm going to show the chart and help you understand. My goal is to get into this on the breakout, take advantage of that energy movement up off of the breakout, and as it runs out about 1 average true range, I am going to sell the stock at a profit, and I'm going to sell one of those options back at a profit. And we just established that my profit would be near about 178. And I want you to notice that these options cost about 163. Now my goal is to get one of those options paid for. And so I'll go ahead and get rid of the stock, and I'll bring that back to one options contract. And my goal is to get that down. Let's say I end up owing $10 on it still. And so I owe, 0.10. Okay. And I would have a very nominal risk, but I would have unlimited reward. So let me hide the chart and just show you. The risk is all that's left is what I have not covered. Hopefully I get the whole thing paid for, but if I owe like 10 or 20 bucks, so what? That's all I have tied up in the trade. And I have unlimited gains. So if that thing ran out to 50, I'm making a fat paycheck on it for not having any of my money tied up in it anymore. My money's back out. I pull my money back out. It's free to go trade other things and to make money elsewhere. But I have this long call, free and clear, no risk, unlimited gain potential. Now, I don't know how far that's going to run, but this is a seasonal play. Every year, on average, oil runs up, particularly from spring to summer, and you always know oil is expensive in the summer because it's when we consume the most. Can you remember a 4th of July weekend where we weren't talking about gas prices? Yeah, me neither. So this is a seasonal play, and I'm going to create an open-ended risk graph, and I'm going to get my money back out and have that paid for. Hopefully you found this information valuable. And again, this is for educational purposes only. But otherwise, we'll see you back here tomorrow. Thanks.